Hey everyone, welcome back to the channel. I'm highly recommended, and I just want you to remember that better credit means a better life. Today we're going to tackle a huge misconception about that trips up so many people on their financial journeys. It's the idea that credit repair disputing and the credit repair dispute process is a form of debt relief. Spoiler alert, it's not. Stick around to learn why confusing the two can hold you back from real financial freedom, right? Okay. Let's talk about the basics of credit repair first. Of course, many of you know that I have been in mortgage industry, mortgage finance industry for a long time, over 25 years. And so I know a little bit about credit. I've worked in credit repair, and credit restoration is what I prefer to think of myself as, more in restoration versus repair. Um, and let's talk about that, repair versus restoration. Okay, say for instance, you have a plumbing system in your house, and like many of us, you've discovered a leak. And say the leak came from a piece of pipe that burst, it was old, and it sprung a crack in it, and now it's leaking. And so I have a couple of choices. I can either repair the leak, or I can stop the leak by repairing the broken section, or I can replace the whole section of pipe um, that surrounds it completely. So what's the difference? Well, the repair is done as a temporary fix. It's supposed to be temporary. Whenever you patch, patch by definition is intended to be a temporary resolution that buys time in order for you to have a long-term fix. And so I think that credit repair is that. People take the credit repair approach, both consumers and folks out there that are in the credit repair business, that they say, well, how can we quickly boost your score so that you can get what you want, whether it's a loan or whatever, a loan, a credit card, some sort of result. And so the idea is, let's look at all the things that we can quickly fix that'll boost your score. I mean, we got everything from not having enough credit to too many negative items, too many bad things, too many inquiries, things of that nature. And so they take an approach of too many inquiries. Well, let's try to get the inquiries off. That'll boost the score. Oh, too many collections. Oh, well, let's try to clear the collections off and boost the score. Which getting rid of negative items is a crucial part of credit restoration, but it cannot be I don't believe it should be looked at as just, oh, what can we do to make the score go up? All the approaches that a lot of people look for, and a lot of companies offer that, because again, they're trying to give people what they're looking for, is they say, what can we do to boost the score? Boost the score. Everybody talks about boosting the score. Nobody's talking about making your credit better, healthier, higher quality. That's my focus. I focus on transformation. I want you to I want you to have a transformation. And I mean, I know it doesn't matter what I want, but I think that folks, when you look for transformation of your credit, you will get a better result than just trying to patch things to bump your score. The score building, improving your credit, I believe is more like chess than checkers. Whereas credit repair is checkers. People are making little moves to try to gain ground. Whereas in chess, there's a list of strategies and tactics that get you to your ultimate goal, your ultimate desire. So I feel like credit restoration is to chess what credit repair is to checkers. And so but that's my opinion. But I think that folks, all my customers that have that approach and follow my strategy, they get the results they want. The folks that are looking for quick step rewards, little boosts here and there for the least amount of money, are not going to get what they're looking for. Not only that, but credit restoration is enduring, it's long term, it's short term cost now, long term up in the end, and it's much bigger than trying to do short term tactics to boost score just to get credit another credit transaction done, right? So, but the true definition is credit repair is a process where you work to identify and challenge inaccuracies, errors, and unverifiable information on your credit report. The goal, to clean up your credit report and potentially boost your scores. That's the industry definition of credit repair. But again, it doesn't erase legitimate debt, and anybody promising to erase legitimate debt or financial obligations. It's not a magic wand that makes a debt disappear. I know I'm not making any friends with what I'm saying right now. If you owe money, you still owe money, even with a perfect credit score. If you got outstanding debts, which you won't have a perfect credit score with outstanding, I'm not saying outstanding debt, but delinquent debt, because that's mostly what we're speaking on. That's the negative items on credit. But and so then with that being said, let's talk about debt relief. Now, debt relief is where the focus is on reducing your debt or reducing it to get rid of it so you don't owe anymore. Restructuring may be changing debt that's delinquent and restructuring it in a way to where it's no longer delinquent, but you're still paying what you owe. Say a refinance. That's a common debt restructuring activity that most people can recognize. Now, keep in mind, debt relief involves negotiating with creditors, consolidating debt, like I was just talking about, or even pursuing bankruptcy in extreme cases. Now, debt relief addresses the money, the finance part, the financial part, not the credit part. Credit repair focuses on your credit profile, your account, how it looks to lenders, and of course, how the scores are calculated to give you your credit score. Hopefully, you see the difference. One deals with a symptom, the other one, which is the credit report. The credit report is a symptom of your finances, because usually if your finances are bad, the credit report reflects that. Now, I have had situations where someone's financing was not so bad, but their understanding of how to handle credit is bad. But usually, in most cases, bad finances is reflected with bad credit report versus debt relief, which is tackling the root cause, is the actual debt. And so a lot of folks who are shopping for credit repair services or help of any kind, they say, I want to fix my credit. I want to fix my credit. I want to improve my credit. I want better credit scores. But then the first thing they say is they don't want to pay for their outstanding debt. They're looking for, and unfortunately, there are some credit repair people out there that market themselves as being the solution to that problem, because they say, oh, I know how to get this off without you having to pay it because it's illegal or it's unverifiable and things like that, which we can do. I do that. If things cannot be verified, then it can be removed. But understand that that's an option, that's a possibility. And if it comes down to being a debt truly being validated and verified by the creditor, we may have to talk about negotiating to pay it off, to get the credit together. And even when you do that, there's a special way you need to do it so that you benefit from your credit benefits from that financial debt action. So you got to know how you do what to do so that you satisfy both. There are ways to satisfy both if you do them correctly, which is what I'm talking about in this video. So why does the distinction matter? I mean, here's why understanding the difference I think is so important. It's very crucial. If you view credit repair as debt relief, You create a false sense of security in one way and a false expectation in another. Let's talk about the false security. You might think you're making um, progress with your financing by making your credit better and making your score improve. But if your debt situation hasn't changed, your problem is still there. Now let's talk about the false sense of expectation. Again, if you're seeking credit repair services with the understanding or with the belief or with the thought that not only will they help you fix your credit, but they're going to get rid of all this debt that, quite frankly and honestly, you didn't pay. You didn't pay what you owe because you had a reason. You didn't want to. Sometimes it's just you couldn't pay it. And so that's how it got delinquent. Now you couldn't pay it then, but now you can pay it there. I mean, pay it now or at whatever point in time you're looking to fix your credit. So that false expectation causes people to not get credit repair help because they keep looking or waiting for a way to fix their credit without having to address these negative items in their debt. Now you can pay folks like me to try and remove these items without you paying through through research and then trying to see if the debt can be verified and all of that, which I don't think is a bad idea for you to try. And if you pay me to try and get rid of these things, to go through the process of getting them validated and verified and then removed if they can't be, or if they're in error, there's no question there. Things that are not supposed to be there, we remove. There's no doubt about that. But things that you legitimately owe, people have a false expectation that credit repair people know how to make that disappear. There are folks out there who hold themselves out that way with the promise, but then after, what sometimes happens is, often happens is, they try everything legitimately, they try, but they couldn't get it removed. And so then the customer, the client, says, oh, wow, you promised me that you were going to get that removed for me. Now you're telling me I got to pay. Well, I think that they didn't, honestly tell them that it's a possibility because they want to make the sale. I don't believe in doing that. I tell people up front, this is the approach. But if it doesn't work, if we find that we got to pay something, we want to do it in a way that's going to guarantee, because just paying off collections does not guarantee your credit is going to go up, because you have to follow a certain process. There's a way to go about doing it that gets you a credit benefit as well as the debt. I'm going to talk about that in another video to go into detail about the dispute process and how to get the biggest bang for your buck when it comes to disputing negative information. But again, by having that false sense of security, thinking your debts are better, your financing is getting better because your credit is getting better, having false expectations about what exactly credit repair does as far as your outstanding debt. And well, I'm not going to go into that yet. I'm gonna save this other part for later, because I don't want to confuse you guys with another aspect that really doesn't is not important right at this moment in time. Now, obviously, a good credit helps you qualify for loans or credit cards, at least most loans. But of course, with mortgages, we got other aspects at play, like income and assets, savings, for reserves and for closing costs, things of that nature. So unless if you haven't addressed your underlying debt issues, you could still end up in the cycle of borrowing, and never breaking free, where you're only making the payments and all your money is going towards making payments, and not making any real gains. Because remember, credit is only part of the financial and wealth equation. We still want to have savings and investments, and we still want to have assets that are going to earn us income when we're sleeping. That's later on. Again, that's the leveraging of credit. Talk about that later. So here's what I think is the right way to approach credit and debt. So what is the right mindset? I talk a lot about mindset. Those who talk to me often hear me say mindset. I use that word a lot, mindset, but it's fundamental. I think it's important. And you can say outlook, same thing, but it all starts with mindset. So if you're tackling your debt, you want to focus on a way to do that. You want to have a plan. If once we determine what's really owed, then we figure out how do we do that. Do we tap savings? Do we tap future paychecks to pay down debt? That now again, this is debt that we've approached with the credit repair process. We've determined that this is debt that is verified and validated. It's legitimate debt. We're not talking about errors. We're not talking about unverified stuff. We're talking about actual debt owed. So we're going to serve two purposes. We're going to improve your financing by getting rid of outstanding debt, but we're also going to get outstanding debt and collections off of our credit report so that our scores rise, get you to 800. So you start with the financial things like a budget, negotiating with creditors after the credit repair process or during, and exploring legitimate debt relief options. Now, if you're thinking about something like consumer credit counseling and similar programs, they focus only on the debt part. And the problem with them is their process, the way they do things, hurts your chances of restoring your credit until they're done. Because here's what happens. Let me give you an example. Okay, I had a client who came to me and they had previously been in consumer credit counseling. Okay, this client, her name is Susan. And so when she came to me, she was looking to fix her credit and she was so confused because she could not understand why, when she went through the trouble of doing not debt consolidation, but debt counseling, and they negotiated with her creditors to help manage her payments, she could not understand why her credit score went down and down and down. When she started with consumer credit counseling, she was at 610, she said. By the time they got done, she came to me, she was at 490, somewhere around there, just below 500. Both the three scores were on either side of 500. And so she first thing she asked me was, I'm confused. I did this. Why did my score go down? And so I explained to her the way consumer counseling works, and I'm going to explain it to you guys like I explained it to her. I said, here's the problem with understanding consumer counseling or any other, whether it's there's various companies that do that. I say consumer credit counseling because that's the one I know, and I'm not attacking them. They're a great service for what they do, but people need to understand the process and the expectations. So this is how I explained it to her. I said, here's what they do. They tell you, sign up with us. We're going to act as your agent. We're going to reach out to all your creditors, which they do, and they negotiate a modified payment schedule. In other words, if all of your bills are $2,000 a month $2,000 in monthly payments, and now your budget is stretched for whatever reason, loss of overtime, loss of pay, loss of job altogether. But typically you got to still have an income. So you have to take another job that maybe it paid less than your old job. And so you're saying you're trying to make it so that you can get more affordable payments. So what they do is they reach out to your creditors. They say, hey, I'm representing you, Susan. And because Susan had a financial setback, and we're trying to negotiate lower payments for her so that she doesn't have to file bankruptcy and you still got a chance to get in your money. Creditors say, okay, what do you got in mind? So now creditor number one says she's supposed to pay me $100 a month. They said, well, can you take 50? And they said, we want to negotiate 50. And they say, okay, what do we do about the because sometimes if a person's already past due, they say, what do we do about the past due? They say, well, can you guys throw it on the balance? And they say, okay, fine. They say, well, what about the part? We're accepting partial payments because that's what they are. How do we do that? And they say, well, you do this. They say, okay. And they'll do that with all the creditors. Here's the problem. Here's where the credit problem comes in. Susan, she had her nice new lower payments. So now her monthly payments that she had to pay out to all the creditors, now instead of it being $2,000 a month, now it's only $1,100 a month. Plus she's paying consumer counseling every month for their service because they're managing this on a monthly basis. Here's where the problem happened. Although all her creditors accepted the partial payments, the negotiated partial payments that the counseling agency arranged for her, it still didn't stop them from reporting her as delinquent. Because remember, her contract, her loan agreement says she's supposed to pay $100 a month every month on a certain date. So what they did to us, they agreed to the modified payment amount, but they didn't change the payment agreement. So what they usually do at first, they stop reporting. So when she started when they accepted the agreement, the following month, they stopped reporting. Then the month after that, they reported her as being 30 days late. You say, wow, 30 days late. How did that happen? She made the new partial payment, but she's not making the agreed upon payments. And under the Credit Reporting Act, they have to report what's true and accurate. And what's true and accurate is she's expected to pay $100 a month per her loan agreement. She didn't, so they reported her as being late. And they're still charging her a late fee. So even though, and sometimes they don't, but usually they, sorry, I had a client calling, but I texted them to call me back because it wasn't a scheduled call. But so what happens is they report it late. And so then the next month they report her 60 days late. Usually, no, I'm sorry. They started out with rolling 30s where she was reported 30 days late, month after month after month after month after month. Then when her past due balance reached a certain level, they reported her 60 days late and past due. So all that missing payment is past due. This is what happens when you do consumer counseling. Consumer counseling's goal is to help you manage your debts and your payments. They don't have nothing to do with credit, but that's what happens because when you modify your payments, it doesn't stop the creditor from still reporting you late because you're not paying as agreed. And so people's credit suffers when they're trying to manage their debt through consumer counseling, which, okay, if you know that up front, that's fine. You know it up front. And so you're making a conscious decision to trade off your credit for the moment, short-term pain, for long-term debt relief. However, with a skilled person who can help you manage the debt, work on the debt relief part, and at the same time, at least not make your credit worse, that's a certain skill, and that's what you want to be able to have. You want to be able to, because I think you can effectively have eat your cake and have it too. You can work on your debt relief and at the same time not torture credit if you do it strategically, which if folks know how to do that, if you figure that out on your own, you can. If you hire somebody that has that, you'll be able to do that as well, all jokes aside. Again, because the purpose of this video is not to solicit your business. I'm here to help you, but I can tell you if you follow a certain set of strategies, you'll be able to manage your credit while you work on your debt issues. So that's the way I think it should be done. Now, again, as you're making progress on reducing the debt, when you're working on the debt part, the right way, not through that, but by negotiating directly with the creditors yourself in a way that says that if you're going to do a payment modification, you're going to do an actual one where your loan terms change, either through some sort of refinance. that's under that option. And so by doing it that way and doing credit repair on your negative debts, one can complement the other so that you can get the financial rearrangement and improvement and get the credit improvement at the same time. The two processes, and in fact, in my opinion, the two processes work best together. Doing one without the other, doing debt relief, not debt consolidation, but debt counseling through negotiated payments only is it hurts your credit. Doing credit repair without addressing the debt is longer and slower and more suffering than it has to be. It's already a process, but that's a process that gives you limited results. By doing both, you get the best of both worlds. They work best together, but they are not interchangeable. That's the main goal. Remember, one is money, one is debt, and what you actually financially owe versus what's being reported as what you financially owe. Because sometimes you have situations where that's not the case. Because I actually, and I have a client friend of mine. What she has is a very unique situation, and so what happened, well, let me finish. What Susan will ultimately end up happening is she had went through the credit the debt counseling program. She had completed it when she came to me, but once I explained to her what they did, now we set about building her credit because we had to get rid of all the negative items because the way they reported. Now the time payment parts that led to collections, all we got to just wait for time for that, but the actual collections that went about, because despite the fact that she was in consumer debt counseling, they still sold accounts to collections when they reached the 120 days delinquent, because her debt counseling program was supposed to be like 2 years. And so, I'm sorry, a year, 18 months, 18 months. And so while they're accepting these partial payments, they're still progressing with 30, 60, 90 days late, default, 120 days late, collections, and then 180 days late charge off. So we had to clean all of that stuff up, because even though she got rid of a lot of the balances and things, all the negative history that surrounded it while she was paying it off still came to bear on her credit. So we had to clean all of that off. Whereas if she had taken a different approach, she could have avoided having all of that and then still address this at the same time. That's what I talk about, where I say they work best together. Okay, so now my client, here's a situation where we're talking about modifying payments. She changed how she got her employer changed how she got paid, and she went from being paid every 2 weeks to every week. Now she has a automobile payment that is I can try to remember what the amount was. I think it's $580 some odd dollars a month. And so what she ended up doing, and her financing is through a credit union. And this is another reason why I tell you credit unions are so great, because you're a member and they have more flexibility with you than, say, a bank. So what she did was, when she reached out last year, or I'm sorry, earlier this year, and she told them, well, the way I get paid now is too difficult for me to make the entire nearly $600, $580 some odd dollar payment every at the beginning of the month at one time. So she arranged with them to pay them weekly, because she gets paid weekly now. So they split up her payment into 4 payments. Well, actually, they did it the correct way, which is the underwriting way, which is they take the monthly payment, multiply it times 12, because it's 12 monthly payments, and then divide that by 52 weeks to determine what the weekly payment would be. They did that for her because she had reached out to them before she reached out to me about it. And she did that. And so they started accepting weekly payments of $160. I believe that's what it was. Yeah, 160. Um, and so they were fine with that. So she was paying automatically 160 a month on auto pay. It's with her credit union. So she gets paid and then they take out 160, 160, 160. So internally with them, she was in good standing. The problem was what I talked about before. She did not do a formal modification or formal refinance. So what happened was they started reporting her 30, 60, 90, just like I described before, 30, 60, 90, 120 days past due to $2,200. And basically it looks like on her credit report, it looks like she's about to get her car repossessed any day now. But internally with the credit union, that's not the case at all. So when she talked to me about it, I looked at her credit and I said, hey, what's going on here? She says, no. I don't know why they're reporting it that way. They're letting me do pay weekly. I said, well, did you sign a modification or refinance? Did you refinance it? She says, no, but they did send me an item in the mail and I disregarded it because I was like, I said, well, that might have been them giving you paperwork to say, let's formalize this agreement that we'll accept $160 a week. So I advised her and she did reach out to them and they resent her this document. But they told her she was in fact past due. I'm not sure how that came about, and I advised her to get clarification on that because I wasn't sure how she would be back past due unless she was past due prior to making this arrangement, which we found out she was. So they told her that if she could, the $2,200 past due was in fact real. That was accurate and true. So they told her if she can make the past due balance, that they would modify her loan agreement to accept the weekly um, payments, and they would report it on her credit as such, and all the negative information, the way they're reporting it now, would go away. So right now she's working on a way to come up with the $2,200 to become past due. In the meantime, I'm helping her out with other things, and I spoke with the credit union, and they assured that they would do that. They would be able to do that once she handles the past due amount. But if you could see there, it's important to handle the debt part so that you can actively handle the credit part. Working the two parts together, you'll get the outcome that you wanted. So um, you have that kind of situation, and then you have others that are odd. But again, at the end of the day, you want to handle both parts. So remember, credit repair is about fixing your credit report, the information on it, so that you get a better score. Debt relief is about fixing your finances, your actual outstanding debt, your debt to income ratio. For those of you in the mortgage space know what I'm talking about. But don't mix up the two. Please make sure you understand the distinction between the two. Now, hopefully, I didn't confuse you anymore. Hopefully, I didn't tick you off. Um, but I want you to manage expectations, because there's so many people out there who want to improve their credit. They want to fix their credit, but they think it's supposed to be done by wiping away that credit repair is going to wipe away their debts, because they're not understanding the difference between the two, and they're having expectations. They're turning away help because of that. They're turning away the possibility of improving their credit, and they're not understanding why that. Oh, I did want to mention one other thing I forgot before we go. When we talk about debt collection and we talk about charge-offs and things of that nature, again, the internet, there are people out there that tell you don't pay off collections, don't pay off charge-offs. But what most of them really mean is they tell you that because they want to get your attention. And then the honest ones, once they get your attention, you go to their website or their program, whatever service they're offering, then they tell you, then there's some dots. When you say don't pay off collections or charge off, dot. Now, the honest, reputable ones will say, without a deletion letter. Talk about that. A deletion letter is when you negotiate with a creditor in advance of paying them, and you say, hey, if I pay this debt off, and this doesn't matter whether you're paying them in full or if you've negotiated a discounted settlement, you're saying to them in this letter that you would have them sign and return to you that they agree that upon receipt of payment of whatever you negotiated, that they would consider that matter closed and that they would remove that collection from their credit report. Now, with the collections I'm talking about in that example are third-party collection agencies. It's not say you got your credit card with ABC Bank, and then it went to collections. You went into default. They closed your account. You didn't pay, and then now you're in collections within the ABC Bank. Your account with them is in their collections department. Then they charge it off. Those you want them to, once you pay them, you want them to update your credit account on your credit report to say this is satisfied, not in collections because it's paid off. You want it to say in the comments to say, instead of saying charge off non-payment, you wanted to say paid as agreed. And so that will improve your credit because all of that negative information adds up to negative data points, which hurts your score. Now, if it's with a third-party collection agency, in other words, ABC, after charging it off, they sell your account to DEF collection agency, who you didn't have an account with. They sold it to them. They sold the debt to them. Now DEF is contacting you saying, hey, we bought this account from ABC. You now owe us instead of them. And here's what we want to do. Now, assuming we validated and verified that they are the legitimate collection agency, that they can legally collect this debt. They've done all of those things the right way. And that's assuming, because we haven't done the process. But assuming we have, then we're paying them with our letter in that case with the third party says upon receipt of payment, if they've already started reporting on your credit, you would say, upon payment, receipt of payment, you consider this matter closed and that you want this entire third party collection account removed from your credit entirely. That's what you want there. That's how you maximize your credit benefits when you're paying off debt, because cleaning up that original creditor account, taking off the collections and making it a paid account, closed, but it's still paid and satisfied, your credit score goes up much higher than if they just change the balance to zero, because they're going to change the balance to zero no matter what. And that's only part of the story. Same thing on the third party side. They're going to say zero if they reported it. Now, with third party collections, hopefully we're doing this before they even report. That's even better. But if they have reported, we're not just asking them to change the balance to zero or update anything on there. We want this entire account removed. Your credit score goes up hugely. The difference between a paid collection that just says paid, and between that and a collection being removed in its entirety is huge. It's huge. People want me to quote numbers. I can only tell you examples. I can't guarantee you what it's going to be. I know in one case I had a gentleman. But with Lily, she's working on that now. I think I said that, but she's working on that to get that resolved. I want to talk to you about another client. His name is Elliot. I think, yeah, Elliot. And so with Elliot, this is what he had. And I talked about Elliot in a previous video, as well as I think I mentioned him in my book, 7 Ways to Beat the Repo Man. But anyway, here's what happened with Elliot. Elliot came to me. He was referred to me by one of my mortgage buddies who had him pre-approved. He actually had a conditional approval, so he was already approved. His credit was decent, but his credit used to be fantastic. And here's what happened. Elliot had a 740 score, before this happened. This was back in 22. And what happened with Elliot is um, Elliot was like one of several people that I talked to, almost 30, between September and the end of the year 2022, where they all had repossessions, automobile repossessions specifically, and many of them were voluntary repossessions, where people were operating under this premise that I had a problem with this car, I'm gonna give it back, and by giving it back, they take it back to the dealer where they bought it from, and then thought that that would just relieve them of the loan payment they made to buy the car, which is false. That's not the way to do it, because this dealer is only the seller. You got to think the dealer is no different from the guy you bought the car off his lawn. You know, they're financing, even though you got the financing at the dealer, it's a separate company. If you look at your loan papers don't never say, if I bought a car from ABC Ford, that ABC Ford was my lender. My lender was usually some bank, right? So that you got that. And so Elliot was no different. And I talked about that, which was the beginning of how my Repo Man book came about, because I said, I got to explain to people that this is not how you handle this. Because what he did was he had problems with the car. He said it's a piece of crap. His words, not mine. He bought it from a particular lender. I'm not going to say their name, but if I say their name, heck, if I even say their initials, because most time when I tell clients this story, I tell people this story when I give talks and speeches about credit. And I just say the initials and people know who they are. And he said the car was a piece of junk. He kept having to take it back and forth to the dealer for service because it kept having issues. And he finally got tired of it. So the last time he took it, and then they called and told him they had to replace something major, he said, forget it, keep the car. And he ignored all the requests and responses from the lender about payment. He stopped paying, and he ignored all of their outreach for collecting the payments. And so obviously he went 30, 60, 90 days. He went in default. And then they actually, and see, the thing is, when they're calling him, they're telling him, hey, you got to make payment. He said, no, y'all take the car back. It's at the dealer. Call them. They'll tell you it's there. Go get the car. But he didn't realize, like most people don't, that your loan agreement says that they can't take action at you until you're in default on the loan. And you're not in default on the loan until 90 days. So they reported, when he ignored them and stopped paying, the car sat at the dealership. The bank didn't come get it. The dealer said the bank reported him 30 days late, then they reported him 60 days late, then they reported him 90 days late. So obviously 740 score that he had is out the window. I estimate, based on what he told me, his score dropped somewhere between 85 and 100 points from this, right? And it was still dropping because at the time when he got his mortgage approval, he was only 30 days late. 60 days late. No, I'm sorry. He reported 60 days late when he first started looking for a house. And then by the time he did his mortgage application and everything, they had updated. His score was down from 740 to 620. He had just enough to get 625, just enough to get his mortgage approval. But the underwriter, just like I would, because I'm a mortgage underwriter, told him the following: what's reporting on your credit is a nearly $12,000 collection. It was $11,980 some odd dollars, that you have to resolve this collection before we'll approve the mortgage on your house. Here's the concern. They're concerned that if they give him his mortgage approval, he buy this house, and with this creditor with a $12,000 outstanding balance would put a lien on his house. So he had to resolve this credit issue before he could get his mortgage full approval and close on his house, which is why he came to me. So I said, after going through the whole thing about, why this is the wrong way to handle a repossession, I said, here's what I'm concerned with. Did you get a notice of disposition? He said, what's that? I said, that's the the document that you got from the bank, because I'm assuming they took the car and they sold it. They either put it back out on the lot, they transferred that, the transfer title, all that. They charge you repossession fees and all that kind of stuff. And then they sell the car. And so now your outstanding balance plus all your late fees, plus the fee they charge you to repossess the car and transfer it back to them, you owe the balance plus all of that minus what the car sold for. So if the car sold back on they gave it back to the dealer to sell again, or sold it back to the dealer or whatever, and the car either sold on the dealer's lot again or sold at auction. And so what did they get for the car? So it's everything you owe minus what they sold the car for. That would be your outstanding balance that's due. That doesn't always show up on credit. Sometimes it do, sometimes it doesn't, but it doesn't always. So one of my first steps in the process that I do for my clients is I get verification of what the actual outstanding balance is from you guessed it, notice of loan disposition. He said he never remembered getting one. Any and everything he got from the dealer and the lender after he gave the car back, he threw away, dismissed, disregarded, and ignored. So in this particular case, the third-party collection agency that was handling the account is an attorney who works locally in a suburb of Cleveland, where I am and where the client was. And so I was able to reach out to him and ask him could he provide a notice of loan disposition to find out what exactly that Elliot owed on the car. So it took a couple days to get that, and we received that, and I received it. And so then I reached out to Elliot, and I said, "Hey, Elliot, I got good news and I got bad news." He said, "Well, what's the bad news?" I said, "Well, I got a notice of loan disposition, and the bad news is you had your outstanding balance plus your late fees plus they still charged you a repossession fee even though you gave the car back, and then and all of that added up, so it was more than what your balance originally was when you stopped paying." He said, "Well, what's the good news then?" I said, "Well, the good news, they sold the vehicle and your outstanding balance is not what's being reported on credit as $11,980 some odd dollars." He said, "What is it?" I said, "Well, you actually only owe $4,536. He said, "Oh, well, that's a heck of a lot better." But he didn't say heck. He said stronger words than that. I'm not going to put in this video. But he said, "Well, that's a heck of a lot better than nearly $12,000. I said, "I agree. I'm with you on that." I said, "But this is a valid and verified outstanding balance. What do you want to do about it?" He said, "Well, I want my house. I want to get my mortgage. So I guess I'm going to have to pay it." So he was both able and willing to pay it. So I reached back out to the attorney who was the collection agent. And I said, "Hey, my client wants to pay this. I'm going to provide you with a letter that says upon receipt of payment that this account will be removed from his my credit report." And so we did that. They accepted it. Well, the attorney initially said, "Hey, I need you to update a few things," which we did. And so then he said, "Was he serious about paying?" I said, "Yeah, I'm going to call him back right now. He's going to try to have payment for you tomorrow." And he said, "Okay." So then talked to Elliot, said, "Hey, here we go. He wants, you want to pay it. He's ready to pay it." And so then we'll get that cleared up. And then once we'll get the proof, and then you just provide that to your mortgage loan officer, so saying that because it's, they're going to go by the credit report. But if we got information proving that it's paid, we don't have to wait for a credit update or anything like that. He said, "Okay, cool." So then we did that. He next day he went to the bank that day, forwarded over a wire. We got wire instructions. He wired the money to the attorney. The attorney forwarded to the lender who he was representing, and the lender, with the letter, that I had the letter just in case they didn't do anything, but they ended up They did that following Tuesday. That happened on a Wednesday. And so that following Tuesday, a week from Tuesday, that following Tuesday, they updated the credit report, removing the third party collection. I forwarded him the documentation with the proof of payment and the proof of release. He was able to take that to his mortgage lender, get his loan approved for his house. But here's the beautiful part. On top of that, getting that cleared up for his mortgage loan, when his credit score updated, the third party collection was removed entirely, and they didn't drag their feet with it. His credit score in his case, his credit score went up 157 points because with the removal of that, his credit score was just about back where it was before he got the collection in the first place. That's the power and the difference between removing a collection and merely just paying it and modifying it. And it's a process, but as you can see, it's one well worth it. Now, as full disclosure, I'm firmly convinced, well, I know for a fact that the reason why that was such a substantial increase in his credit score was because that was a large account. Remember, it was reporting as 12 grand. So to have a $12,000 collection removed from your account does wonders for your credit score. It does wonders for your file as well. Now, if you owe less, the positive impact may be less, but as you can see, it's meaningful, especially when you consider you're paying what you owe. So think about that when you're cleaning up your credit, because whatever money that you're hoping to save in the credit repair process that you got earmarked as debt relief, you pay what you owe and your credit score increases. What you gain in the long run is far beyond those few $100s, even a few $1,000s if that's the case, because the money you save on your credit, on new loans, lower interest rates on your car, lower interest rates on your mortgage. You save tens of thousands of dollars in lower costs over the life of those loans versus a few $100 or a few $1,000s there. So again, short-term pain, long-term gain, huge gains in the process. So there you got it. Just remember, fixing your credit is credit repair or credit restoration. Fixing your finances, that's debt relief. Hopefully you found this video helpful. If you do, I strongly ask you to subscribe. But more importantly, I'd like you to like and share this with other people who may want to know this. And please put comments below. If you like this video, if you don't like it, tell me what I can do better. If you like it, tell me what you want me to talk about, because right now I'm discussing the topics that my clients come to me with. There may be stuff out there that I haven't heard yet. I think I've heard it all, but you never know. But if there's folks out there that want me to talk about a particular aspect of credit repair, it's so much to it. If you need me to drill down on one thing of importance that's on top of mind to folks, I'd be more than happy to make a video for that. I want to reach as many people as I can. I want to help as many people as I can, because remember, better credit means a better life. And so better life means better finances, better wealth, and is in addition to a better home and a better car. So again, this is Hiley, and I'll talk to you guys in the next video.